overall, COMEX is coming out of every category, registered and eligible in total for the last 4 weeks. It's coming off of COMEX.
Welcome to Gold Silver Pros.
Hey everybody, this is 𝙈𝙁𝙏𝙉 from goldsilverpros.com. We're reporting this on November 19th, 2022. It's a Saturday. You guys will see this on Sunday as the report is released to its various outlets. As for the gold price, we closed the week at $17.5104, down Friday $9.12. For silver, we closed the week at $20.94, down 3 cents. Overall, the metals did pretty well, dating back to the 4th day of November, where they've come up quite a bit, over $100 on gold and over $2 on silver. So overall, they did well, but closed the week a little bit on a weak spot. Looking at the regular markets, Dow Jones Industrial Average up 199 points on Friday to close the week at 33,745. The S&P 500 is up 18.78 to close the week at 3965.34. The Nasdaq was also up about $1.11 to close at 11,146. And the Russell 2000 small cap stocks were up $10.61 to close at 1849.73. Cryptocurrencies, of course, were hammered due to the FTX fiasco and some other bad news. Bitcoin is right now trading at 16,639.16, and Ethereum is at 1209.48. And most of the crypto complex is down, although there is some green for Friday. There was a nice little pop on Friday. The rest of the markets are mixed. In terms of the bonds, we still have over 4% on the 2-year, but now we have under 4% on the 10-year. The 10-year is at 3.829. The 2-year is at 4.531. So we're still in a yield curve inversion scenario. In fact, we're yield curve inverted to the 10-year for every single issuance, shorter term issuance, the 7-year, the 5, the 3, the 2, the 1-year, the 6-month, and the 3-month. With the exception of, well, not the exception of the 1 month is slightly trading over the 10-year. So the entire yield curve related to the 10-year, which is the benchmark, is inverted, which means we're probably headed for a recession. Overall, the markets didn't have a great week, sideways trading, and there was a bunch of news this week that was the reason. So we're going to go over the data points. The New York Fed has raised their 1- and 5-year inflation expectations. The 1-year last month, they had it at 5.4%. Now they're saying 5.9%. And this is a year out projection. Their 5-year projection is it'll be 2.4%, which is higher than 2.2%. So the New York Fed apparently sees there being higher than expected inflation dating out 5 years, although they think it's returning closer to the benchmark 2%. Producer price index final demand was 0.2%, which is on expectations. And we have a tale of 2 different manufacturing indexes. The Empire State Manufacturing Index had a positive 4.5, which was a recovery of last month of negative 9.1. So it appears as though in New York, some of the manufacturing came back. In terms of the Philadelphia, it was negative 19.1. So Philadelphia wasn't doing so well. So a little bit of mixed signals on manufacturing, the economy. We're going to have to continue to look at some other data points to give you an idea where that's going to go. We'll get into housing now. Real household debt up 6.9%, real mortgage debt up 8.2%. That can be blamed both on persistently high prices and on interest rates, which have been rising. Retail sales were okay at 1.3%. We see a nice little boost heading into the holiday season, although not anything in particular to encouraging that we're going to have a massive shopping season. We'll have to see the data when we get into next week. Black Friday sales, Cyber Monday sales, and everything around Thanksgiving time. Retail sales, excluding vehicles, non-auto, was also 1.3%. Import price index, prices came down 0.2% that were imported. Industrial production overall was down 0.1%. Again, have to see from a manufacturing production index in the U.S. where that lands. It doesn't seem super strong, but there's been, some data going back and forth, which I think, given the amount of inventories we have in the system, is probably likely to go down, but we'll see. Looking at capacity utilization rate to that point, it's down to 79.9% this month. Year over year is 80.1%. And what that means is we're not using all the capacity that we have in the system, that it is falling, and that inventories are largely going to rise. Business inventories to that point are up 0.4%. Rounding out the housing data, the Home Builders Index is a 33, the NAHB, which means home builders are not positive on what they think is going to happen. Existing home sales, 4.43 million, which was slightly higher than the expected 4.37 million, but down from last month at 4.71 million. And a batch of leading economic indicators that economists look at, just various things, is down 0.8%, again, indicating we are in a recession. Home builder sentiment, I want to focus on that for a moment. It sours in November, and here's a quote from the article. The National Association of Home Builders monthly confidence index fell 5 points to 33 in November, the trade group said on Wednesday. It's the record 11th month in a row that the index has fallen. Outside the pandemic, the November reading is the lowest level since June of 2012. Last November, builder sentiment stood at 83. So overall, building not doing so well, and the real estate market is not strong right now. That makes sense with rising interest rates and the fact that consumers have been stretched and are using more credit, and we'll have to look at that going forward. We're going to get into the gold and silver part of the report, so I will share a screen and walk you through the data as reported by the CME Group. And here we see the gold data, the gold futures. There was, after that big pop that we talked about last time on the program, of increasing interest, we've seen a fall in interest. So that's falling during the middle of November month. It looks like there's a lot of repositioning for the December contract here, and some of that repositioning has fallen off. And what we look at, we had for the December contract, the dominant contract, 171,292 open contracts. You can see it was changed negatively of 15,000. 12,000 went on February. So February is the next big active month that's starting to come into play, and that will be the one determining the prices. But for right now, we're going to look as well at the December data. Exchange for physical on both months was over 1,400. We had 1,461 contracts exchanged for physical between COMEX and London. And on the February contract, we had 1,428. Those are decent sized numbers, which indicates either people are going to London using their positions on COMEX to get gold, or just to play arbitrage with the prices, or to settle other contracts, other third-party contracts. Looking at settlements, and this is where we get our pricing, December is still the dominant contract with 137,677 contracts for Friday, the 18th of November. You'll notice that we have 32,000 contracts on February. That likely means about 32,000 of this volume here was moved into the February contract as the positions on the derivative market for gold move into the next contract. Remember, this is a futures market, not a present market. On Friday, we closed down $8.60 to sell at $17.5440 on the COMEX. You can see a little bit higher prices in February, which means gold right now is really not in backwardation, at least in terms of the regular trade. We're going to move on to silver. So as we look at silver, again, a fall in open interest usually means people have probably were moving positions to the February contract here or closing them out. And then we've had a lot of that done mid-month. And so we had a little bit fall in open interest. December is still the dominant contract, although it's starting to move to March. So one difference on COMEX that you may not expect, gold and silver don't always have their dominant contract months on the same month. They always do in December because it's the end of the year and people are positioning for end of year positioning. However, throughout the year, they'll have different dominant contract months. For gold, it was February of 2023. For silver, it is March, where people are taking their positions. You can see on the amount of contracts closed on Friday's data. We see here, this is Friday's data. Looking at the EFP numbers, 370 contracts of 5,000 ounce silver were exchanged for physical between the COMEX and the London markets. Nothing too impressive there. Let's go to the settlement data. As we look at the settlements and see the effect on price, you can see by far more in silver than in gold. December is still the dominant contract month. You saw some rotation into the March contract, but only to the tune of 9,600 contracts. About 5 times that number are still trading in the active dominant month, which is December 22, which would be this December. Silver is actually up 22 cents on the COMEX as of Friday's trading data to close at 29.97. If we go back a little bit to Thursday, it closed down about 55 cents on average on the contracts. We go back to Wednesday, it was up 6. Go back to Tuesday, it was down 0.595. And go back to Monday, it was up 446. So overall, about a middle of the road month for silver, nothing too big there. Well, that is the COMEX data, ladies and gentlemen. Let's go to the big data, the ETFs and the funds that store a lot of silver. And this is also combined with COMEX. So one little point of detail we get on this chart for COMEX is you can see a 4-week change, as you can see here, 4-week change in terms of numbers and in terms of percentage. So not only the daily, but 4-week is graphed here by Nick Laird on goldchartsrs.com. And you can see that we're all down. We're all red. So overall, COMEX is coming out of every category, registered and eligible in total, for the last 4 weeks. It's coming off of COMEX. What's happening in the London markets? Most of this ETF metal is stored in the London markets. Not all of it. Some is stored in New York or other places, but predominantly in London. So this gives us a good picture of what's going on in the UK in terms of the withdrawals. And you can see overall there have been about the same amount of withdrawals from the ETFs as there were from COMEX. So COMEX total is 1414. You subtract 1414 out of that, and you're going to get 1450-ish out of London. So a little bit more gold taken out of London and those various ETFs than it was on the American exchange. Overall, gold is leaving. And if we look at the big daddy of them all, the GLD by SPDR, which is the big gold ETF, you can see overall ounces have been pulled out of that as well. And this is dating back to silver squeeze. The same thing happened in gold and silver. They were being pulled out of the ETFs dating back to silver squeeze in late January, early February of 2021. Now on to silver, same thing. Here's the COMEX data. You can see silver has been a much higher withdrawal rate for the last 4 weeks. We've been down 8.3 million ounces. If you look at the ETFs over the last 4 weeks, SLV has seen an even larger withdrawal down than has the COMEX, most of this being stored in London. It was drawn down the last 4 weeks, 13 million ounces, almost 14 million, 13,917,948. Overall, if you add the US and London markets together, we're down about 20,108,000 ounces being taken off of the market into private hands for silver. If we look at the dominant ETF storing metal in London, it would be SLV. And again, since silver squeezed a precipitous fall, a little jump lately, a little baby bit here, but overall it's being taken out. And if we go directly to the London market and their reporting just as a confirmation source for what we have here, considering that a little bit of this is not stored there, we look at their report, and last time we report on this, there were 871 million ounces. Now, a lot of this is claimed and not free, so it's a mix of claimed and free. The majority of it is claimed and some sort of ETF or other contract, some is free float. We don't get that reporting from the LBMA. Likely, they may not have that data without going to the various constituents or hold metal in those vaults. So in any case, we went down from 871 million ounces the last time we reported to 852 million ounces. So we're down almost 20 million ounces of silver in a very short period of time on the LBMA. Silver is being taken off. You can see the big trend here, but is just being slammed and slammed and slammed off of that market. Gold is being withdrawn from London too, a little bit, not quite as much. Of course, you can see that on these charts. You see that some gold is taken out of London there. It's about 1.4 million ounces, and silver is about off of London about 12 million ounces, and you can see that here on this reporting. So they basically, for the most part, match up, although they aren't done exactly over the same time frames. That's going to do it for the screen share. Kind of wanted to give my final thoughts here. It appears as though we've had some weakening economic fundamentals. We've had some surprises. The New York Fed manufacturing index popped a lot higher than people thought it would, so that's kind of a positive sign. Although that doesn't really overall, it's a drop in the bucket in terms of all of the GDP or the economy here in the US. It is important to watch manufacturing. I think job quits and jobless claims are about where people expect them to be. So unemployment from just a current last couple of weeks perspective seems to have evened out a bit. It's not moving violently in one direction or the other. Housing market continues to plummet. We're beginning to see very strict weakness in the housing starts, new housing builds, mortgage activity, and we're seeing a rise in prices in terms of servicing current mortgages, which means there are some adjustable rate ones out there, because in a fixed rate world, it doesn't move unless your taxes and insurance go up and you're escrowing and you're doing the full thing in one payment. But the overall mortgage payments are going up, which signifies with more interest expense in there. Prices have not, because they're going up, interest expense is going up faster than the mortgage prices are coming down. So net prices are still rising, which means less people can buy. So I expect that effect right now, since we haven't had a meeting of the sales price and the interest rate to keep that steady for consumers to buy at the same price overall relative to their budget, since that's still rising, the interest rate expense is higher than the reduction in prices. I think prices are going to have to fall to match that, not only to catch up at any specific point in time, but the overall rate that we've seen the last 11 months that we've started to see weakness in the residential housing market. Overall, the economy is doing okay, I guess, for the last week. Inflation was lower than people expected. It was 7.7% year over year, whereas in previous months it had been the 8s, and we'd seen, I think, over 9 at some point last year. So it does seem like the government reported inflation is easing a bit. That is no consolation for people that see actual real prices, because real prices don't seem to reflect what's going on in the CPI. And I think the biggest testament to that is to go to John Williams' website, shadowstats.com, and look at his reporting on inflation, which uses 𝙂𝙇's methodology consistently across all the data, and allows us maybe to have a little bit better view on what inflation actually is versus the government's reported version, which has a lot of adjustments to it. mathematical adjustments to it, which are very subjective and I don't think reflect reality of prices at the pump, of prices at the grocery store, of prices at the title company when you're buying a home or paying rent or paying your electricity bill. I think inflation that the consumers are seeing is much higher. So it'll be interesting to see what happens to the government CPI numbers going forward. This is going to do it for the market wrap. Thank you for those at Gold, Silver Pros and JM Bullion who have been watching it. This will be it for this one, but remember, content on both channels coming this week. We're going to keep pumping it out for you guys. We're going to keep you up to date with what's going on in the economy. Visit both JM Bullion and Gold Silver Pros YouTube channels for more information. Until next time, this is Robert Keens.